Hello everyone, today I will do a Dropbox stock analysis video. I will do a small overview on their business, analyze their financials and valuation, then I'll talk about the risks involved in investing in this company, and as always, I will tell you guys what I think about this company, their valuation, and if I would invest in this company or not. So please smash that like button and subscribe since it really helps my channel out. Also remember to claim your 2 free stocks with Webull by signing up with them and depositing $100. The link for that is the first one in the description below. I have always seen Dropbox only as a cloud storage feature and nothing else, but the truth is that they have way more things within their platforms. They have been creating all these different features in order to have an excellent smart workspace in which they offer collaborative apps, professional sharing, project management, and more that helps companies organize their documents and connect with their workers in a much easier way. They have their traditional Dropbox cloud content, their Dropbox transfer, which lets people share, view, and download large files. Then they have Dropbox passwords, which lets their clients sync and store their passwords safely in the cloud. They offer the computer backup service, which lets you automatically back up all your folders on your computer and store it in the cloud. Dropbox Vault, that lets people store their passport, tax documents, and financial statements securely in the cloud, which could be really helpful in several situations, and have way more features within their platform such as Dropbox Family, Dropbox App Center, and Hello Signed. Dropbox is one of those companies that the pandemic has helped with acceleration of their growth, mainly because everyone is working from home. In my opinion, this is a type of service that people will not stop using after going back to normal or going back to their office space. I think this because it is an excellent product, easier to use and very convenient for companies and a personal use. So yes, they have benefited from their pandemic, even though it doesn't seem like that in their stock performance. I'm saying that it doesn't seem like that because if we compare it with other companies that have benefited from the pandemic as well, such as Fastly, Zoom, DocuSign, PayPal, or even Carvana with their online business model, their stocks have gone up between 100 and 800% since the drop in March, while Dropbox has only gone up 19%. Even since January 1st, all these pandemic benefited stocks has gone up massively between almost 90% for PayPal to more than 600% with Zoom, while Dropbox only 13.57%. I do want to say that I am comparing it with these companies and not with their main cloud competitors such as Microsoft, Google, or Amazon, mainly because those three companies' core business is not the cloud, is advertising, technology products, and e-commerce, and have benefited as well, but not only from their cloud segment, but also if we compare with those stocks, it is also a huge difference. Dropbox is currently trading at a price of $19.84 per share, has a market cap of $8.2 billion and a PE ratio of 248. Now, something that impressed me a lot is that their forward PE is 22.12, which is very low for a growth tech company like this one. For example, DocuSign has a forward PE of over 200, Zoom over 170. The forward PE ratio compares the stock price of the company to its forecasted earnings. So having a forward PE lower than the other similar growth tech stocks could mean that it's either undervalued or at an excellent price point. Same happens with the price to sales ratio. A price to sales ratio is calculated by dividing the market cap by the revenue of the company during the last 12 months. This ratio helps us see how much the stock market or investors are actually valuing the company's revenue. The lower the ratio, the better for investors. Right now, Zoom has a price to sales ratio of 113, DocuSign around 37, Fastly around 54, while Dropbox has a price to sales ratio of 4.5. This indicates that according to this metric, again, the stock is undervalued since it is trading 4.5 times its revenue. Now, Dropbox is a company that has had an exponential growth in their revenue year over year and quarter over quarter. In their last quarter, they reported a revenue of $467.4 million, which is a growth of 16% year over year. Something I liked about them is that even though their revenue grew 16%, their cost of revenue actually decreased a bit. Because of this, their gross profit grew more than 4% in comparison to the same quarter last year. It is a company that has never been profitable until this year. Last quarter, they reported a net income of $17.5 million, while last year they reported a net loss of $21.4 million. It actually impressed me that even with a growth of 16% in the revenue, they were able to manage their expenses and not only be profitable, but also improve by 181% year over year. Now, their cash and cash equivalents actually decreased by 3.5%. They have total current asset of $1.2 billion and total current liabilities of $981 million. This leaves us a current ratio of 1.2, which is right where I like to see it. I like to see this number between 1 and 1.2, and everything above 1.2 is excellent, but obviously 1.2 is also very good for the company. Now, they have total assets of $2.74 billion and total liabilities of $1.9 billion, leaving us with a total liabilities to asset ratio of 0.7, which is a little bit high since I like to see this number below or at 0.5, but 0.7 it is still manageable and good. Not excellent, but good. As always with every investment, there are some risks involved. The first one and most common one is their competitors. There is Google with Google Drive, Microsoft with Microsoft One, Amazon with their AWS, and even Apple with iCloud. I do see cloud storage as a commodity or as if it is converting into one, mainly because it is something that people are getting and using on a daily basis and do not care if it is a 10 GB cloud storage on Dropbox in Microsoft One or Google Drive. Yes, I know each of them offer different things that differentiates them, but it's something you guys have to take into consideration. Another risk is their customer conversion. As you can see, they have 600 million registered users, but only 2.5% of them are paying users. And that demonstrates that it is a huge challenge for them to convert those users from free subscriptions to paid subscriptions. I'm one of them. For example, I have the free version of Dropbox because I only use it to store my notes from Notability app, and the free version is more than enough for me. Then I use Google Drive for my research for my videos and spreadsheets for this video and other personal things. And then I use iCloud to store everything I have in the Documents app in my computer to have it available in my iPhone, my iPad at the same time. The only cloud storage that I actually pay for is iCloud, since the free one is not enough space to store everything I have in my computer. The problem with this, in my opinion, is that most of their registered users feel that the free version is more than enough and do not offer something better for the paid version. I'm thinking as a plan for a single person, and obviously for a business might be better to pay a subscription to be able to use more features. For example, Spotify is a platform that has their free version, but if you go premium, you will be able to download music and listen to music without Wi-Fi. It will be able to avoid advertising. You can play any song you want and can also skip the songs that you don't want to listen as well. This makes people want to pay more because it is a hassle and very limited option to only have the free version. That is why 45% of their active users are paid subscribers. That is something Dropbox has to figure out how to do it. It might not be a huge thing since they continue having an excellent exponential growth year over year, but it's definitely something you guys have to take into consideration for the long term. Now, analysts are expecting them to report a revenue growth of 14.4% for this year 2020 and are expecting them to have an earnings per share of 0.78 cents per share. Now, if we calculate their PE ratio with this earnings per share by dividing their stock price of $19.89 by their expected earnings per share of 0.78 cents, we get a PE ratio of 25.4, which is very, very good for the industry. Now, Dropbox were the pioneers in the cloud business and their growth is excellent. Since their main focus is the cloud business, they are able to innovate and make their platform way better with a better design and easier to use than its competitor. In my opinion, they have integrated excellent new services that are attracting more and more clients, and that is why they are seeing excellent growth. Obviously, there are some risks that could slow down their growth, but I think that they will be able to come up with more new things or with an idea to attract more subscribers to their paid platform. I do have to say that I like the growth the company has been having year over year and do think they could continue like that. I do think also that it is a good investment for the long term, but for the long term only at its current price of around $19. I wouldn't invest in this stock and expect huge returns in a month or even a little bit more unless something huge happens, but I'm saying this because I don't want you to think that I will invest in this stock and sell it for a big profit before year ends, because I don't think that's going to happen. I hope you enjoyed this video. Remember, I have a completely free Discord group chat, which the link for that is down in the description below. Please smash that like button and subscribe since it really helps my channel out. Also, let me know in the comment section below what you think about Dropbox. Have you ever invested in it, or are you thinking about investing in it? Thank you and see you next time.